Welcome back to Mornings on 2, the 9:13 is the time. The Bay Area, one of the most expensive places, as we know, to live in the country. And as the cost of living continues to rise, consumers are racking up credit card debt. Data from the Federal Reserve shows credit card debt has climbed to nearly $1 trillion this year, with young adults struggling the most. In fact, delinquencies are close to 2.5% of cardholders, but has risen to more than 8% for adults under the age of 30. Joining us now for tips on budgeting and reducing debt, Jason Matthews, founder of Matthews Financial and Insurance Solutions in Oakland. Thank you so much for joining us.
Thank you for having me.
So first of all, interest rates are up. So certainly that's making it harder to pay off this debt. What else are you seeing are some of the biggest reasons why people are racking up the debt?
I think what it is that people, during COVID, a lot of people got a lot of stimulus money. They increased their quality of life and their standard of living. And so they try to maintain it by using credit card debt and all types of debt. And everybody thought it was going to be this cheap, free money forever period. And that has all ended with rising interest rates right now.
Yeah, and COVID, we also had less expenses, right? We weren't commuting to work. We didn't have, a lot of those expenses we have now. What do we get those ads in the mail all the time or our email, transfer your balances over. Is that a good suggestion? Because I do know that sometimes people go, oh, I can transfer my balance over, but that low rate is only for a short amount of time.
Right. I always tell people you have to have a plan. Right? So you just don't do something just to do it, right? So the average credit card interest rate went from 14% now a little bit over 24%, which is drastically high. So what I would say is, yes, you should take advantage of it if it's a reliable company. Try to transfer it over like an 18-month or 12-month or even possibly 24-month. But knowing that you're not trying to do that, get that old credit card you had and raise that debt back up onto that one, but have a plan on, I have these 24 months or 18, whatever that period is. Let me go ahead and reduce that credit card debt with that plan intact before we get this huge balloon payment, because rates might go up even higher on these credit cards after the end of that period.
I see that you also suggest people try to negotiate rates with your card holder. How successful is that?
I think if you get on the phone, you could have, it depends on who you talk to, ask for a manager or supervisor, say, hey, right now these rates are kind of pretty high right now. I got an offer for lower rates. I want to keep my business relationship with you guys, or you want to lower your rates. And some credit card holders might be like, you know what, we will lower that rate for you. So that's a great thing that you should also do as well.
How about for homeowners? Are you still seeing people able to get an equity line? Because then at least if you transfer credit card balances over to an equity line, perhaps, or some of your expenses, right, you can deduct that from your taxes.
Right. So more and more what we're seeing is, even though the refinance market has pretty much dried up or collapsed, we're seeing more and more people go ahead and get seconds or HELOC loans and using that to pay off that credit card, and especially because it's a lot lower rate than you will with those credit cards at that 24%.
Okay, now I think there's always a debate. Many people are trying to save for retirement. You should, as soon as you get that first job, right?
Immediately.
Immediately put that in. But at the same time that at some point we start also saving money to pay for college and our retirement, and then we have bills, and our cost of living is going up. So what is your priority? Should we pay off the debt first, reduce 401k payments, save for college? What do you recommend?
I always say both, right?
Okay.
So what I mean by that is this. One is you always want to start saving always for your emergencies, and you also want to pay off your debt at the same time. Well, I notice how the universe usually works is, as soon as you pay off all that debt, an emergency happens, and if you don't have that savings, you're going to go right back into debt. So what I always say is you want to balance it out between how much you're saving and also for emergencies. Now, with your 401k plan, automatically do that match no matter what. That's free bonus money. You got to take that money. But when it comes to college, I always say is when you go to the bank, right, you go to the teller, there's a department where you get a home loan, there's a department where you go to a business loan, but there's not a department for a retirement loan, right? So you have to know when there is retirement, nobody's going to save you but yourself. So that has to be more important than saving for college, where you can get a student loan for that for your children.
I hear that a lot. People say you got to let your kids worry about themselves because you're going to have to worry about yourself in retirement.
Exactly.
Sadly, because college is very expensive. All right, what about credit counseling? What if somebody is just, I am overwhelmed, I come to you for credit counseling, what kinds of things can you help someone do in just getting from being overwhelmed in debt?
I think one thing is is one thing, you get your head out the sand usually helps out a lot. So oftentimes when we get overwhelmed, we want to put our head on the sand. We don't want to deal with it, right? We have this burden. We can't sleep. We have anxiety about the first situation. So the first thing is, it helps you is, what is my current situation actually looking like? Number two, what can we do to get some small wins? So I always feel like if you get some small wins, it gives us more encouragement, gives us more confidence, and we know how we can accomplish the rest of the task. So when you work with an advisor or a credit counselor, they're going to help you figure out what is that game plan supposed to look like, and structure, and give you the end, that light at the end of the tunnel that you need, instead of just putting your head in the sand, getting these phone calls, and your credit ratings getting worse and worse and worse.
And also contact those banks and your creditors, because as opposed to waiting for and worrying about that call or that threatening call, you need to have this paid off. You're contacting them, so now they know you're going to work with them, right? Exactly,
and that's what it is. It's all about communicating, right? I think if you communicate with your banks, your credit card companies, or whoever you have your loans with, I think more and more the lesson that they got from '08 was they didn't want to take all these losses, and they don't want to write you off on the books. So it's better to them to communicate with you and work with you, instead of you doing nothing, then they have to write off all that debt. So they are willing to work with you. So you just have to communicate with them and not put your head in the sand, because they're willing to do something, because they don't want to take those massive losses that we saw back in '08 during the Great Recession.
All right, don't wait for the collections call.
Don't wait for the collects.
Call, make arrangements. All right, Jason Matthews, thank you so much for joining us. Matthews Financial and Insurance Solutions in Oakland. Thank you.
Thank you for having me.
Good information.